Well, what we're going to do today is it's a little bit different than we had planned. The guy that was planning on being here wasn't able to make it, and so we're going to kind of call an audible. We're still going to cover the same topics or similar topics with trading with defined risk, but what I thought we would do is do a little bit more application, looking at a live market environment, and then we'll look at a couple of trade opportunities that might be setting up for the day, and we'll go through how to use those with Nadex. So real quick, what I'd like to do, I'm going to actually share my screen, and I've got a good friend of mine, Nathan from Winner's Edge Trading, that's going to go through a couple of charts with you, and he's going to do some chart analysis, and then we'll kind of take that back and see how to use that with Nadex. So yeah, there will be, yeah, Mike, when Darrell's able to do it, we will do that. So this one's just going to be a little different. We're going to do more applications, just kind of throw up some charts and some trade ideas and try to show you guys how it works. So real quick, what I want to do before we get to the charting section and before we start going over charts, I'd like to go through how Nadex works. And real quick, type in a yes or no. How many people have traded on Nadex before? Just type in a yes or a no. All right, okay, good. So most of you guys have not. That's a good thing. So we'll go through how this works. So what we're going to be looking at today, we're actually going to be looking at some currencies, okay? And so there's two types of products that Nadex has, two types of products. There's a binary product and then a spread product, all right? And first we're going to talk about the binary product. So if we were to look at, let's say, we'll click on the Forex and we'll click on the Euro USD and we'll look at the daily that expire at 3 p.m. Hey, is the sound okay for most of you guys? I want to make sure you guys can hear us. And okay, Jim, it might be on your end. If you click that blue X in the top right, it'll actually reset for you. All right, so let's go through how a binary works. So right now I'm gonna, and this is the Euro USD, I'm going to click on the 137 even, the 1.37 binary, okay? And can everybody see the screen? It says Euro USD above 1.37 by 3 p.m. Everybody can see that right here? Okay, I've got it highlighted. All right, so basically what this contract is saying is that we feel like the euro will be above 137 by 3 p.m. today. Now, right here you can see the actual price. Okay, you see the actual price is at 136.94. So we're about 6 pips away from getting to 137. All right, so the way that this trade works, let's say that I've got Mike and I've got William here in the room. All right, let's say that Mike says, hey, the euro is going to rally, it's going to go up, it's going to be above 137 by the end of the day today. All right, well, if that's the case, Mike would want to buy this binary, and the way that this works is that at 3 p.m. it will either, or say the Euro USD will be above or below 1.37, right? So it's going to be one or the other. It's either going to be, and you see it's greater than, so if it's at 137 or lower, then this is going to expire at 0. All right, if it's at 137.01 or higher, then that would be in the money and it would have a payout of 100. So you see right now, you see a bid ask of 40 by 45. All right, so the way this works, if we've got Mike here in the room that thinks that the euro is going to be above 137, we've got William Duncan here in the room that says, hey, the euro is going to be below 137. So Mike's going to say, hey, I'm going to buy this thing. Okay, I'm going to buy one at 45. Now the thing with Nadex is that every single trade has defined risk and a defined reward. So if we buy at 45, if the max it can go to is 100, what's our max profit? Okay, yep, max profit is going to be $55. All right, and you see down here, you don't have to calculate it, it tells you right there, $55 max loss is $45. So again, that's per contract. Now if I trade 10 contracts, obviously now my max profit's $550, my max loss is $450. If I trade 2 contracts, max profit $110, max loss is $90. trade 1, there you go, 55 and 45. And it tells you the market ceiling and the market floor is 100, the market floor is 0, right? So basically, if I'm confident that the euro is going to rally, I can buy this at 45. As long as it's above 3, as long as it's above that at 3 p.m., I'll get $100, okay? Now, if I'm bearish on the euro and think it's actually going to go down, then all I have to do is flip this to a sell. Now all of a sudden I'm selling it. If I sell it at 45, my max profit's 45 because the lowest it can go 0, and my max loss is going to be 55. All right, does that make sense to everyone? So if I sell it and the euro drops and goes down, basically I'll make $45. Does that make sense to everyone? I want to make sure you guys follow me. And the binary is pretty straightforward as far as the binary goes. All right. So again, that's how the binary works. Now, obviously, if you think about it, we're at 136.95. That's only 5 pips away from the euro. That's based on 3 p.m. There's different time frames here. So if I click on the 10 to 12 p.m., so here's one at 12 p.m. that I'll look at 137.08. You see this 137.08 euro is trading at 21 by 26. So I've got less time to get there, and I've got to go a little higher. So the way to look at a binary is think of it like a probability. So basically what you're looking at here, if you're willing to pay 27, the market's basically telling you, hey, there's a 27% chance that the euro gets above that price by 12 p.m. Eastern time. So again, basically that would be giving it about 2 hours for the euro to rally above 137.08. Now, if you don't think that the euro is going to rally, you flip to the sell and you sell it and basically take advantage of premium. So if you think of this trade, and you might look at it and say, hey, is it really worth risking $73 to make $27? If you think of it on a return on risk scenario, if you make $27 with $73 of risk, basically that's a 36% return on your money. And so you have to think about it and say, okay, you know, I definitely don't want to take a full loss at 73%, but some of these trades where you are selling it for 20 or selling it for 30 do make sense. And the way is that you would do your analysis on the euro. If you feel like the euro is going down, then it makes sense to take the trade. What you don't want to do is just look at it and say, hey, I'll pick up a quick 30 bucks here and just sell it and have no idea where the euro is going. It all comes down to understanding market direction. And then you can choose the binary based on how confident you are in that market direction. All right, so that's the binary process. Now I'm going to go through the spread, and this is really the cool thing about this contract. All right, so I'm going to look at the 7 to 3 p.m. here. All right, and see if I can find a euro. Okay, everybody see this contract. This is a spread between 134.40 and 136.90. All right. So what this means is basically I'm trading a range on the euro, meaning that if I get short, the highest it can go is 136.90 against me. If I get long, the lowest it could go against me is 134.40. So let's say that we're looking at the euro and we think that the euro is going to be really volatile today. Let's say that, you know, this is like last week where we had the FOMC minutes, and we think, hey, you know, I'm really bearish on the euro. What you can actually do is look at a spread like this to sell it when you're close to a ceiling. So again, see right now we're right at 137. Okay, we're right around 137. So you might say, well, hey, why would I trade this if it's at 136.86? And I'll show you why real quick. Basically, if we're able to short this thing, we're able to short a euro contract with $5 of risk. All right, so let's say that we wanted to short 100 contracts. Okay, this is where the math can get kind of crazy. All right, so if we short one contract, all right, so we're actually going to be short from 136.85, but the euro's trading at 136.98. So you might say, hey, you're giving up 13 pips to get short. Well, yes, you are. However, this is really a very low risk, high reward type play. You'd want to do this type of a play when you have a strong feel about the market, like, hey, I think the euro is going to drop 200 pips today, or I think the euro could break, you know, 150 pips, and you could really take advantage of it. And so the positive part of this is the fact that you can really if you look at it, each pip movement on this is going to be $1. All right. So if you short 100 contracts, that would be a risk of $500 to put that trade on. But if the euro would start to drop, basically, that would be $100 per pip movement. So if it dropped 100 pips today, that would be a $10,000 move, if that makes sense. All right, does that make sense to everyone how that works? So basically, you're just trading a range. So the highest it can go is 136.90, the lowest at 134.40. So again, basically what they're doing, you're having to give up a little bit of premium in order to get that spread. If you only wanted to trade 10, basically you can risk $50 and it's going to be like trading a standard lot on the euro. But again, you would want to take that type of trade in the event that there's some big news coming out or you feel like there's a powerful move. But it's a really powerful contract to use, and you can actually use these to hedge in the spot market. So let's look at this again and say, hey, I think the euro spot is going to go a lot higher today, okay? But you don't necessarily want to have to put a stop in. What you can do, basically, for each 10 contracts, you're basically hedging a standard lot in the spot market. So if I'm able to sell this at 136.85, all right, and I sell 10 at 136.85, then basically that's going to protect my position all the way down to 134.40. So in a way, it's a lot better than having a stop because this contract is good until 3 p.m. today. Whereas a stop, if it traded down, hits your stop, and then goes back up, you actually lose money on the trade. So again, that's the spread. Another way to do it, if you just look, you can trade this, just within a spread. Let me find a contract here. Okay, here's the other way. Let's say that you feel like the market's going to go higher. So if you feel like the market's going to go higher, you see we're trading at 136.98. You can buy this thing with a floor of 136.90. So we could be long the euro all day today until 2 p.m. Basically risking $16 a contract. And if the euro rallies, then we feel like it could really take off. We'll risk $16 to possibly make $200 if we have a 200 pip move. So again, some really powerful ways to play this. And so what we're going to do now, I'm going to turn things over to Nathan. He's actually going to pull up a couple of charts. So Nathan, if you want to go ahead, I'll stop my projection and you can get yours started, start your desktop sharing. And he's going to go through just a couple of markets and then we'll look for a trade opportunity and try to take his analysis and then bring it back to Nadex and look at it. All right. Hey Jim, yeah, Nathan's getting his charts loaded and shared with you guys. Hey Chip. Now we've got Chip Frame from Nadex in the room, so if you guys have any Nadex related questions, he can definitely help answer them. So did the spread make sense to everyone? I want to make sure you guys understood that, how that worked. Basically, you're just it's like trading in a range. So you've got a max and a minimum. Right now, Nadex, you can just trade directly on the exchange, Leo. And so the way that trades work basically is it's a 90-cent commission per contract, and it's not a commission, it's an exchange fee. So it's 90-cent exchange fee. There's no commission fee per contract up to 10 contracts. All right, so again, that's up to 10 contracts. So the way that works is basically your exchange fee maxes out at 10 contracts. So if you trade 10 contracts, your exchange fee would be $9. If you trade 20 contracts, it's still $9. Your margin is just the risk. So your margin is the risk on the other side. So whatever your defined risk is, that's going to be the margin to put up the trade. So technically there's no margin. So like for instance, if you on a binary, let's see, that is trading at 40, if you buy that at 40, your risk on the trade equals 40. I'll type this, if you sell at 40, risk on the trade is 60. Does that make sense to everyone? Okay, give us 1 second here. Let me get this chart going. Okay, first thing we'll look at here is the EUR USD. Correct. Yep. Just 1 second to load. All right, Nathan, you want me to start off on hard or 5 minute, 4 hours? I've got 4 hours or down. Just tell me which one you want me to do. I'll turn it over.
All right, guys. Let me apologize first of all for not being able to load up my charts. I don't know what the deal is with that. You'd think that after so many webinars we'd get this stuff figured out, but that is not the case. So, Morgan, you have the euro up right now. Okay. All right, guys. So when you look at the euro chart, we are right around 137, and 137 is a critical level. Morgan doesn't have the weekly chart up right now, but 137 is a huge level on the euro dollar. And so, like, for instance, if you were to pull back to a weekly chart, and you just have to take my word for it or draw it on your own chart, you can see that there's multiple weekly points on that weekly chart. Notably, December of last year, when the euro was on one of the biggest surges in the past 10 years, it stopped on a dime at the 137 level and fell almost 1,000 pips. And so obviously when something like that happens, you're talking about a weekly chart, not a 5-minute chart, you draw attention to that level. And so then price had stayed below that level for the following year, and then just recently in September, I guess the end of September, is when we broke back through 137, and what do you know, we went right exactly to 138, another key level. And so that's one of the things you'll find, specifically with a pair that's so heavily traded, like the euro dollar. It's the most traded pair on the spot by a very large margin. So you have so many people watching it, so many people having an eye on the technicals, and then so what happens is these key levels, specifically those round number levels, become even more important on a pair like the euro than other pairs, because so many traders are watching that and so much money is being flooded into the market at those key levels. So when they're broken, when they're tested, when things are happening around those levels, you want to pay really close attention. Now, Morgan was talking about the binary. We don't trade binary, we trade spot. But one of the most difficult things to do in the spot market, for instance, is, if you think the price is going to reject off one of those critical levels, which often it is, you have to calculate how far you think it's going to go from that level. You want to short it at 137 because you're expecting a bounce play. Okay, well, maybe you want to put your stop at 137.25, something, give it some room, but then where do you target? And there's a lot of ways that you can figure that out, whether it's drawing Fibonacci extensions or using past levels or whatever the case is. There's a lot of ways that you can try to define your target. But if any of you are familiar with spot trading, you'll know that one of the most difficult things to do is to get out at the right place. So one of the cool things on the binary side is if you want to play 137, you can say, you know what, I think it's going to finish or it's going to close at 3 p.m. below 137. That's all you have to say. You don't have to put in a target at 136.40 or anything like that. You don't have to pick your price. And so from a level standpoint, that Nadex option is actually very attractive. And specifically when Morgan was talking about the ability to hedge those trades, it makes a lot of sense. So let me get back to the technicals on this euro. In September, we broke above 137 and into 138. And immediately when the euro got to 138, it reversed again. And not only did it come down to 137, but it came way below that, all the way past 133. So that's like a 480 pip drop in 2 weeks. And then it rallied right back up to 138. Again, almost to the pip, it rallied back up to 138 and reversed again. So what you're seeing in the euro is not just random motion and money flooding in and out. What you're seeing is it working to break a critical level. And so a lot of times when there's a major level, and again, these are a lot of times whole numbers like 136, 137, 138. If you draw your lines on all of those 100 pip key levels, you'll see a lot of action. So typically what happens is the market will fight that level for a period of time, and it'll either go into that level and break it to fake people out, and it'll accept a lot of long orders, and then it'll do what we call a squeeze, where it'll crash back below and suck out all of that money out of the market, which then fuels it to go back and break it again and actually continue and go a lot higher. And so we call that is a break and retest. more often than not, when the market's going to break a critical level, you'll see it come back, retest that level, and then continue up. So what we're seeing right now is a very critical decision point for the euro. We're right at 137, and we had just been at 138. So the question that you have to ask yourself from a technical analysis standpoint is, right now as the market's floating at 137, is this a retest of 137 to go low? Are we looking to come back, back to the 130 type of range, which is a very common floating range for the euro? Or are we trying to build up power and build up orders so that it can break above 138? Because as soon as we break above 138, we're talking about hundreds of pips of what I would call clear room or open space before the market's likely to run into a major level. So right now is a very critical decision point. And typically what happens and what separates winning traders from losing traders is that when the market's at a decision point, losing traders are doing what the market's wanting them to do. Either that's a squeeze where they're jumping in too late and then getting sucked down, or they're getting in early before the break and then they're getting stopped out. The losing traders are doing exactly what the market shape wants them to do to take that money. Whereas the winning traders, whether that's because they're patient or the opposite, they get in early enough, are taking that money that's being sucked out by the losing traders. So one of the things you want to do if you want to be a good trader is you want to really study how the market reacts as levels, because the market is random to an extent, and anyone who tells you that you can just learn these patterns and all of a sudden you'll make all this money, it's not accurate. But if you study the way the market reacts around levels, you'll start to understand kind of the structure of how the market makes these moves. Why does it go up and test certain levels and then crash? Why does it, sometimes it fakes out and sometimes it's a full-on breakout? What are the things that are establishing these moves? And when you learn that, all of a sudden the plays around these levels become a lot more clear. So for instance, to give you a personal example, if I'm looking at a 4-hour chart on this euro dollar, then I see that we tested 138, we came back down through 137 with a lot of strength, and now for the past few days, it's kind of slowly churned back up toward 137. So if the market tests 137 and we have a little kind of it's not much of a trend line, but you can see kind of the structure that's building from 136.30 basically up to 137. If it breaks that move back to the downside after testing 137, that's a short, because that's a break, retest, and continuation move that's continuing to respect 137. Now, again, what a lot of traders will do, they're either short right at 137, where there's no confirmation that the move is coming back down, but they just know that's a good level, so they're short, or they'll buy right as it breaks 137, and there's no confirmation there either. It could still be very easily be a fake out that goes to the downside, or that reverses when people think it's going long and comes right back down. So when Morgan was talking about getting confirmation or having a specific idea of which way you think the currency is going to go, rather than just betting on these Nadex binaries, like you're gambling, one of the best ways to do that is to wait for confirmation from movement from a specific level. And we could talk about the euro for 2 hours straight, going back bar by bar and talking about where there was confirmation, where there was no confirmation, where it's just fake outs, and you'll see specifically where people were losing money. A good example of that is when it broke 137 and then came back down through. So for example, Morgan, if you're able to scroll back on that chart just a little bit for me, you can see all that momentum going up on the left side of his screen. Well, the reason for the most likely that happened is because of some of that downward movement prior to that. People were thinking, okay, it's going off 138, we're going short, and people were shorting the market. And very commonly what you'll see is when the market starts picking momentum back to the downside, it'll stop at a critical level, just like it did at 137. It'll spike up enough pips, and this spike was about 100 pips maybe. It'll spike up about 100 pips on an intraday level, because most stop losses are going to be less than that, and then it'll come right back down to the motion it was going to do. That's why trading becomes difficult, because you can be right about the direction and still lose money. And most people don't fully comprehend that. They think, okay, trading is about picking the direction. Well, in binary, maybe that's the case, because there's a time expiration or at least more the case than spot. But what's really important is not picking the direction, but picking the timing with the direction. So a perfect example of that is right now, as this is coming toward 137, we have a decision point. If this euro breaks back down and say closes below 36.80, we have a confirmation of a short. Now, does that mean it's going to go down 100% of the time? No. We try to win about 40% of our trades because we use positive risk to reward. But waiting for the market to give you confirmation from these levels is a much safer way to trade than to randomly pick your direction or pick it based on a moving average cross or try to just use pin bars or candlestick patterns. All of those things are good. That's good education. But in order to trade effectively, you have to understand the structure of the market a lot better and then play that structure with confirmation tools, only taking the trades that are going to give you the necessary risk to reward. Morgan was kind of going over those different risk to reward opportunities. One of the things that we teach our students is that a trade setup, just because it meets XY criteria, does not mean you should enter the market. Maybe it's a perfect pin bar that comes off a level, breaks through a trend line, it gives you your confirmation. Okay, well that's great, but then are you risking money to make half of that profit, where the market's still in a range that could easily come up and take your stop loss, or in the binary case would be just a negative max risk compared to your profit. And so what you have to do is understand there's a difference between how the market works and getting trade setups and actually when to pull the trigger. And one of the most common things that that we see among amateur traders is that they're constantly getting in trades without really qualifying those opportunities and making sure that they're giving themselves an edge on every single trade. There's a difference between having a good strategy and actually dialing that down so that you have an edge on every single trade that you take. And that's what we need to be. That's why so few percent of people are actually making money, specifically in intraday trading, is because they've fallen into this idea of, oh, I have a strategy, so I'll just take trades. Well, unfortunately, there's a lot more to the puzzle than having a good strategy. You have to really dial it down and understand when to take out trades, when to add to trades, when to use a time stop, when to use a hard stop, when to hedge your trades. I mean, there's a lot more to it than just figuring out, okay, if price bounces off a level and does this with the moving average and whatever, then I can enter the market. That's what the entire flock of traders who are newer traders coming to the market are doing. They're finding a strategy, they're following the rules, and they're losing money. And that's what we try to avoid, is to just be one of those people who have a strategy and follow the rules and then end up losing money, and then a year later we have no account and we're done. So I'm sorry to ramble on this. I know that I tend to do that on specific topics that I worry about traders struggling with it, but this is one of the major ones. So let me quickly check with Morgan here, because I think maybe his speaker is here. Okay.
All right, great. Thanks, Nathan. I really appreciate you.
Actually, let me switch to this pound just for 2 minutes. I don't want to leave you just talking about one currency, because although the pound and the euro are correlated, they're actually in very different situations right now, where the euro looks like it's actually an opportunity for a break and continuation to the downside. The pound has kept its head above the 162.80 level and the 163 area. Even now, it's just breaking above 163.50 as we speak. There is a lot of upside potential, and it would actually be pretty difficult for the pound to break lower. 162.80 to 163 is a 15 pip major heavy zone of support and resistance, and so the pound has broken above that and has kept its head above that for, let's see, 3 weeks now. So we're talking about 3 weeks where the pound has stayed above that level. It has not yet surged and made a move to 167 or 168, but that's what it looks like it wants to do. There's a lot of back and forth. Very likely that what the market's doing right now is having some head fakes to get people to jump on and suck some cash out. You can see, if you look at a weekly chart, which I know Morgan doesn't have up there, but I'll just explain it to you. You have 3 pin bars in a row where the market shot up past 164 and then even up to 165, and then settle all the way back down at that 162.80 level to pull money out of the market. So very likely what we're getting ready for is a launch to higher prices. And so we want to get prepared for that, but we don't want to jump on at the wrong time. You don't want to buy this as it's spiking up into 165 because you're just buying into resistance, and the market's likely going to get you right back down to 162, 80, 163, and then you have an 80 pip, a negative 80 pip head start on the trade. 290, and then as it's slinging, as it's like, you know, breaking the tops of these candles, like 163.75, for instance, that's when you want to get your long. That way, when it gets up to 165, you already have a head start on the trade compared to the other traders who are buying at 165, and if it comes back, they're way down very early on, or even if it goes up, they're a huge profit disadvantage. So the pound dollar, because it's staying above this level, is a completely different play than what you look at the euro dollar. And actually, it's probably setting up for a really nice hedge opportunity where if the euro breaks down, you can short the euro dollar, whereas you can go long on the pound dollar. And if you're holding both of those trades, it's a nice hedging opportunity, especially if you're trading both with a positive risk-reward ratio, because even if you win one and lose one, you're going to be net profitably ahead. And that's a really good opportunity because the pound and the euro don't always give you those opportunities since they're correlating more closely. Okay, guys, so that's my quick analysis for you. Again, I apologize for not being totally prepared to give you some analysis, but I hope kind of looking at these levels and talking about how they work together is helpful for you. And I think that if you study that and you really focus on level reaction, it's going to give you a great advantage in your trading compared to a lot of the people who don't even understand the fundamental aspect of how the market's moving with those levels. All right, Morgan, thanks for having me. I appreciate it, and great talking with all you.
All right, great. Thanks, Nathan. I really appreciate it. And guys, remember how we looked at that example just to kind of give you an idea of how these things move. Remember earlier before Nathan started talking, we looked at the 137 binary on the euro, which at the time was trading at about 40 or 45. And you see now that we're trading at 137.12, so you saw the euro really start to rally. You saw that the euro is now trading at 70, about $70. So again, that just shows you that these things are really good trade opportunities. And you can see here, I'll show you the chart. This is actually a chart of the binary movement. So for those of you that are short-term traders, let's see, sorry, let me find this, 137. Let's see if I can get this. Here we go. Here's the binary chart that you see. So again, we were looking at it about right here. This is the 5-minute chart, and you saw as the euro broke above 137, you saw the binary breakout and spike as well. So again, for those of you that, if you trade short term, there's some really good opportunities to trade these. Even if you trade longer term, you know, like we looked at some of those spread contracts that were pretty powerful, you know, where you were risking basically about $15 to be long the euro all day if you felt like it was going to break out, or vice versa. So Nathan, thanks again for coming in here and sharing your analysis. We appreciate it. Nathan's with the guys at winnersedgetrading.com. I'll put that link, and trading.com. All right, so again, Nathan, thanks for sharing that. And now we've got Darrell Martin, who's going to share a couple of things with you guys on dual breakouts. So Darrell, if you can go ahead and start your screen sharing. I'll stop mine on my end. So Darrell can go ahead and start your screen sharing for us. And the key, guys, with looking at this is that basically it's the same market you're already trading. You know, if you trade any of these markets, if you trade any currencies, if you trade any of the E-minis, if you trade gold, crude oil, corn, copper, silver, soybeans, the E-mini S&P, the DAX, the FTSE, the NASDAQ, the Dow, the Russell, all of those contracts basically have derivatives on Nadex Exchange. So again, you can trade these with defined risk. So again, that's very important to understand. So Darrell, looks like you got your screen sharing going. I'll go ahead and turn things over to you, and you can take it away for the last part of this webinar.
All right, Morgan, thank you. And yeah, those were some just fantastic trading lessons. Sometimes the smallest lessons and the big lessons. I mean, you got to put all the pieces together, and I completely agree. Uh, to confirming what Nathan said is, you develop a system, and you got your rules to a system, but you don't want a system to run you into the ground, because you don't take into account the reality of the market's moving, the reality of style. And I liken it in some way to, sounds funny, but a professional poker player, somebody who actually knows what they're doing and, wins major tournaments like Bill Helmuth or something on a consistent basis. The reason I say that is because they don't just look at the stats. They look at the other players' faces. They look at the tell signs. And they're like, you know what, this isn't what I want to be doing right now. And so you got to look for those signs in the market and go, you know what, this is not my trade setup. And I was talking with one of our traders the other night, a trader I've been working with a lot. We're working on a whole nighttime trading strategy. It's been going incredibly well. And it literally is just, it's for, literally just nighttime traders, early AM session traders. And, it may work during the day. We just haven't even tried it yet. But I wanted to focus on that. And the thing is, one thing he's learning as I'm going through it with him is he's like, I find these trades, and sometimes they're actually good signals, but there's just not the right binary. There's not the right contract there for me. Or sometimes he has great contracts available, but it's not really the right system. He can push it, but if he found that if he does try to push it, that it doesn't turn out as good for him. And so it's getting all those different pieces together. And one of the things that I've learned to look at, you're talking about volume spikes and, looking at spikes on markets on the euro and those pieces. When I do trades, is I really look for spikes at, you can call them, support levels, whatever you want to call them. I use what I call deviation levels. We give these out for free on our website, by the way. But we give out these deviation levels, and we track them on all the Nadex market, all the main Nadex markets. And if you go over here and check them out, what we do is we look for when there's massive volume spikes. And for instance, what this indicator is doing is actually going and looking at the futures volume on the euro dollar, even though we're following the euro dollar spot, to see is there a volume spike on the market. And if there is a volume spike on the market, then once the market's moved a certain distance, that's the trade that we really want. And so like over here, like for instance, we go into yesterday's, the 20th, and check out the volume spike. What my ideal trade setup, you'll see when I teach this all the time. My ideal trade setup on these is I'll go in and right when it's moved a deviation. So this orange line is a deviation, and that's a statistical measurement, basically like 30% of the time we really don't expect it to close outside that area. We expect it to bounce back off of it when it hits it. And but we want a confirmation. We want something else that tells us that. And so we'll see right here on that one deviation move, see it went down half and then it went up to the top half. So you got negative 0.5 and then positive 0.5. When we see a volume spike above this level, that's when we expect the pullback. And so whereas if I went in and I tried to do the pullback right here, after it just ran up and did a volume spike. That volume spike meant nothing to me, and I could be trying to play like support resistance, it's like, hey, it came down, it went up, it came down, it went up, and now I go short. And I go short just at the wrong time, and the thing flies up against me. So by waiting on that one deviation move, and then also waiting on, not just like going, okay, it moved from, negative 0.5 to positive 0.5, so that's one from high to low. And I'm just going, okay, now that I did that, I'm just going to go short. But waiting for it actually to have a volume spike before I decide to go short. That is putting the right pieces of the puzzle together. It's not just the fundamental concept of where the currency is going to go. It's not just the technicals of what I see in the chart, but it also includes another aspect of reality in trading, which is the simplicity of basically statistics. Our deviations are not support resistance levels. They're not Fibonacci levels. They're not pivot points. They're based on implied volatility. We actually take the expected movement out of the option pricing, because the options tell you how far the market thinks the market's going to move that day. We take that pricing out, and then we plot, this is how far the market tells us it's going to move today. Now, it doesn't tell us which direction. It just tells us the how far. And by using that, that gives us a massive, massive edge. Now, one of the things that really, really helps, we were talking about in a couple of topics to go over was range-bound trading and also breakout trading. Range-bound trading is really, really cool trading. It's premium collection trading. You got to do it at the right time, okay? And I had an opportunity come up the other day, and I don't want to say these happen all the time, but they're easily identifiable when they come up. And it came up at one of the craziest times at the FOMC. And on the FOMC, what happened was I went in and I pulled up the scanner. Okay, I actually did 2 steps. One is we have this news trading plan, which, by the way, is free in our website. So feel free to come over. We go through and we analyze all the news for the week, and we tell you, hey, here's what to expect, and here's how far markets move. And so I was over here, and I was looking up at the FOMC last week, and trying to find just a really good trade to take advantage of this FOMC breakout. It's like we know the thing's going to move, and I went down, and I was looking at pound dollar, and on the pound dollar and on the euro dollar both, I found that I had an average range expectation of 73 pips 2 hours after the announcement came out, meaning from high to low, once the FOMC statement came out, press conference, all that stuff included, I really didn't expect more than a 70 pip move, okay? And, well, there was an issue. I went in to buy a straddle. Now, let me show you what a straddle looks like. Okay, and you can use the spreads, you can use the binaries, to go different directions on these. And so if I went in on the the pound to do a straddle, I pulled it up, and like the cheapest decent expiration, which was really 3 o'clock, was the only expiration I could find. I went in, and when I pulled it up, and then we'll grab one. There's like 63. See if we can find a couple that line up for us. 63.40, 64.90. That one ain't gonna work. See if we can find even one on here with the market movement already in the day. I know I can find them. I'll just drop the filters real quick. Here we go. Okay, so let's say we're going for a 3 o'clock here, and we'll find one other one that will line up for us. Just looking down the list, trying to find a really good example of a straddle. Here we go. Get rid of these options, that way it's clear. There we go. Okay, that's a straddle. Okay, what that means is this is your profit and losses, how much I can make, this is how much I can lose, and I make money if it goes up, I make money if it goes down. Okay? And so I was looking for a straddle. But my issue was the straddle cost me literally a little over $70. So who can tell me? Here's a pop quiz, just common sense. You don't have to know anything about NADEX question, okay? If it costs me $70 to put on a trade, 70 pips to put on a trade, and I only expect the trade to move 70 pips, how much money should I expect to make on the trade? Nothing. Yeah. And so it can be so easy to have that trading system, just like Nathan was talking about. It's so easy to have that trading system where I expect, I'm going to do a straddle because pound dollar, euro dollar, man, they move. And some of the stats are really convincing. I mean, the euro dollar moves 95% of the time. We're looking for this move. Pound dollar 83% of the time. And so I'm going to straddle this thing on the news. But I don't stop and go, wait a minute, there's something else that's telling me that this isn't a good idea, and that's the risk. The risk is all built in. Like all 70 pips of that was built into the trade. And now what I love about Nadex is everything is defined risk, okay? And so I've really learned to embrace the concept of if this doesn't work, why don't I just do the opposite, okay? If I can't make money by it going up and going down, either way, if it has to move far enough and I don't expect it to move that far, well, then why don't I just do the opposite thing and expect it to say range bound? And so, what happened down here was the announcement came out, and, I bought here, okay, and I sold here, and I put all these pieces together. Anyway, so the market ran up, and it literally ran up 82 pips. We expected exactly like 71. So a little bit further. Of course, the average was 71. So some are 80, some are 60. It ran up 82 pips. So if you bought that straddle, you're up like maybe $10 on the trade right now. And that's, you got to include bid-ask spread, exchange fees, everything else. You're probably not in up $10. You're basically probably about a break even right now. And you really needed to move a whole another 70 pips. You needed to move double the expectation for you to even have a decent, one-to-one risk-reward possibility. And I'm like, you know what? Forget that. I'm going to do the opposite. And so I went in and I said, well, you know, if I'm basically risking 35 and 39, so we actually had a 74 pip, cost on the buying side. So I'm going to collect the 74 pips. I'm going to say it's going to stay within the 70 pip range because the probability of it going way outside of it is really, really low. And to walk you through some of this, to make it make a little more sense for you here, if you get this concept, it's so powerful because what I did was I did the exact opposite of what the average trader would do. Okay, I went in and I bought the 62.40 to 63.90 spread over here, and what that means is I bought the upper one. Okay, so I went in and then I sold on this side. I'm sorry, yeah. So yeah, I bought the lower one. So usually you would buy the upper one, right? Does that make sense? You think it's going to go up, you buy it. And if you think it's going to go down, you sell it. But I did the opposite. I said, I'm going to buy the lower one. So instead of being the guy that's paying 35 pips, I'm going to be the guy that's collecting 35 pips because the market was right at 63.90. Okay, so if I'm able to go in and buy something at 63.51, just think of it this way. If I'm able to buy something at 63.51 and it's at 63.90, is that a good deal? I mean, don't get all complicated about options, but is that a good deal? Is it better to buy down at 63.90 when something's currently trading at, that price? So, yeah, I mean, it's definitely much, much better to buy, you want to buy high, you want to sell high, you want to buy low, okay? Think about it. Right here, we got it at 63.90. I can buy at 63.51. So if I can buy at 63.51 and something's at 63.90, would you do that right now? Like, let's say you're just trading spot Forex, and you could buy something at, 40 pips lower than where the market was. Right now, would you do it? Yeah, I mean, if you could do that, if you could actually accomplish that, that would be what's known as arbitrage, which means guaranteed profit. We were looking at euro dollar. If you're sort of confused on what I'm saying, if you could go in right now, and we got the euro dollar at 37.07, okay? If you could buy the euro dollar right now, not back here when it was at 63.72, but at this very second, you could buy it at 63.72 right here. Let me pull up my crosshair there for you. You could buy it right here. I mean, all day, all week, right? Because, you'll buy it and you sell it out, and you'll make a guaranteed profit. Now, I'm not talking about having a guaranteed profit. What I'm talking about is that's the concept we're playing on. We're buying lower than where the market is already. Yeah, buy it and sell it immediately. So, anyway, so if we go over here at 63.90, and we're able to go in and buy this thing, 63.51, okay? So right here is the price I bought at. So you could say bought right here, okay? And it's the price I sold. So that's the sold price, bought price. So I bought this lower spread down here, and I sold this upper spread. So if we went over to the spread scanner, I sort of did the opposite of what it said. So I literally inverted the entire trade, and I found this one, and I sold it, and I found, let's see here, right there. So literally, see that little edge right there? And that's what I want you to see. I just want to give you an example. This gray scale right here is where the underlying market is. That's where the actual, say, pound dollar is located, okay? That difference right there, that's that premium I'm collecting. Now, of course, I'd want it to be a little bit larger, so we could give ourselves even a better, if we can find a better one right now, it's late in the day, it's not usually going to happen, but if we found one. But anyway, so that premium was what we were collecting. And this is really powerful. You're going to be amazed by this when you see the net result here. Okay, so we're basically going in and we're going to collect 39 bucks on the one we bought. We're going to collect 35 bucks on the one we sold. And the reason most traders wouldn't do this is it seems completely counterintuitive. Because when I pull up the trading ticket, here's what's going to happen. I'm going to go over here and I'm going to find one of these, So let's see here. If I went for one of these binaries like this, that was more in the money down here. There we go. We'll find one. There's just not a ton of implied volatility, being the day of the week that it is. With the let's find a low risk $20. There we go. That one's perfect. Okay. So right here, if I open this ticket up, okay, and I did the opposite, like $23 profit, $127 reward. Well, everybody's going to be like, no, I'm not doing that. Okay? Thing is, they're not looking at it the right way. It looks like it's $127 risk. It isn't $127 risk. Why is it not $127 risk? Well, if we go here and we put these two things together, 35 plus 39, how much can I make? Okay, I can make, 4 pips, right? Well, let's do some basic math. If I can make 74 pips as my max profit, but I can only lose 111 on the one above, and I can only lose 115 on the one below, wait a minute, I can't lose all of that because, think about it, can it expire both above and below? Is there any way where it can expire above and below? The 1.6550 and the 1.6250, can it be both above and below that price at 3 p.m.? Is it possible for your dollar to be both above and below that price at 3 p.m.? It could be in between it, right? It could be above it. It could be below it. But it cannot be above 1.6550 and below 1.6250 at the exact same time. So the euro dollar itself cannot do that. So what I do is I go up here and I go, well, what was I going to make? This is the most I can lose on the one I bought. What can I make on the one I sold? 35 pips. So if I can make 35, now we go over here and go, well, that plus that means the most I could lose, on the one I bought is only 76, because that would mean if I took max loss on the one I bought, then that means I took max profit on the one I sold. And then the most I could lose on the one I sold was 115, but I could make 39 pips on the one I bought. So the most I could lose, 115 I sold, the most I could make is that 39 I bought. And so that really means my worst case scenario here is 76 pips loss to 74 pips profit. That's an acceptable, very close to 1-to-1 risk-reward ratio. Okay? And the only reason I saw this trade is because I was like, I can't do this trade. I want to do a straddle right now in pound dollar, and I can't because it's too expensive. And I go, wait a minute, what? If it's too expensive, how expensive is it? It's so expensive that there's like no way I can win on this. Like, I should not expect at all to win on this trade. And therefore, wow, wait a minute, maybe I should be doing the exact opposite thing. And so I went, I did 20 contracts, okay, on the trade. And so I went in and I'm like, okay, so what does that make my max risk and my max profit and all that? The most I could have lost on the trade was like 1,500. The most I could have made on the trade was 1,480, okay? And now I only make my max profit if it expires right in the center. So if I take this right here and we can get rid of the little middle drawing. But I could only make that if it expired right in the center, like on that black line. That's the way I'm going to make max profit. But at the same time, I'm only going to make max loss if it expires above this, which means the pound dollar moved 150 pips. Okay, more than double the average that it moves on FOMC. Or if it moves down 150 pips, again, more than double the average it moves on FOMC. So my probability of making max loss is low. My probability of making max profit is semi-low. Now, what I will tell you, if you trade FOMC for any period of time, you know that markets have a big tendency to move in both directions and then cross back at least 2 to 3 times from where they were right before the FOMC. But I only start losing, and this is the cool part, okay? Like, here's max profit. As of expiration, I only start losing 1 tick at a time. So instead of like doing like what I teach as an iron butterfly on binaries, where you sort of lose everything if it expires above or below the strike, I'm only losing $1 a tick if it expires above. So every tick, every pip above that the pound dollar expires, my 70 pip safety range, remember, because I had like that safety range of how much I collected. I collected 74 pips. So I got 74 pips up. Above that, I can only lose $1. Now, every pip below that expires, I make $1. And odds are in my favor that it's not going to go really much beyond 70 pips. And so what happens on this trade, the sort of the net result is I end up getting a 150 pip wide range. You could call it iron condor, you could call it butterfly, with like an hour and a half to go. I did this trade live on the radio last week. I put the trade on Wednesday on my radio show. If you check my archives over on the website, and then on Thursday I walked through this in like extreme detail. And but I had a 150 pip wide range where I break even or make money anywhere inside that range. And market ran up, so it started going against me a little bit, and then it came on back down, and we netted out a $780 profit on the trade. Now some people go, wait a minute, wasn't your original risk, $1,400, on the trade? Well, not really, because it was $1,400, but again, that requires it going above 150 pips. So what was my realistic expectation? Was that I really wouldn't see this thing fly up 100, 120, 130, 140, 150 pips. And so it really does allow you to go in and do premium collection. And think about it, this isn't like 1 week iron condors and vertical spreads on weeklies and, I used to do that. I did that stuff, weeklies and monthlies a long time ago. This is an hour and a half trade where you're making that kind of return on a 1-to-1 max risk to reward ratio. So, it's a phenomenal way to do range-bound trading. Now, this is spreads. I also do butterflies, and I'll look at them. And the difference between doing a spread and what I call an iron spread or, iron condor, iron butterfly, whatever, is I'll do them on the spreads if there's so much premium that it's too expensive because it's actually a better model. I'll do them on the butterflies. Most often, I'll do these before the news. And the butterfly is sort of the exact same concept of I think it's going to stay within this specific range. But what I do is because I'll go in and I'll say 90 minutes before the news, the FOMC, the Aussie dollar has a high to low range of 25 pips, the pound dollar 40 pips. That I actually have how far the currency is going to move before the news or has moved before the news. And so we hopped in on this one on the pound. We actually euro dollar, pound dollar. I looked at Aussie. It was only 10 pips wide, but I was actually able to get the pound dollar on. And we were able to throw the pound dollar on and get right around a 20 pip wide butterfly and pull the trade off. And the way that we did the 20 pip butterfly, here's how I found it. I went over here to the binary scanner. If you're not using this tool yet, by the way, it's free. Just hop in and start using it. It's the best thing. You will love it. Okay, it makes what I call a better way to trade. It makes it easier to trade. And so I'll go in here, I'll click on binary scanner. Just click your reset filters if you don't know what's going on. Type in $65 risk because you're taking a higher risk trade because you're doing premium collection. Bring this on down and then choose whatever it is you want to trade. And what it's going to show you right away is what is available for trading. So if you were hopping over and we were looking at maybe a euro dollar announcement, okay? I go, okay, what do I have that's premium collection based on euro dollar? Well, I have, this one's pretty tight, but there's a 10 pip wide one where I could buy this one for 71 and sell this one for 30. And this lets me know right here my max profit. It does all the math for you. So instead of having to open the Nadex ticket to see how much money I could possibly make, it's right there for you. So I can make $28.50 on this side. I could go over here, I could make $31 on this side. That gives me a 60, whatever, not quite a 60, but like a $59 profit potential on the trade if it expires in between 36.98 and 37.08. So that'd be a range-bound trading strategy on the binary, sort of like how we did on the butterfly, and we got it a lot wider over on the spreads. And it's live. You don't have to hit the refresh button. You can choose what strikes you want to look at. If you want to look at more expiration times, you can bring it out further. If you want to look at several currency pairs at the same time to find the best trade, you can break it out further. So basically, you can go in and you can access all of this information live in demo and on all the Nadex markets right here inside the scanner. So instead of going over here and going, okay, which one is, because this is the hardest part about Nadex. Once you get it down, And once you have your trading strategy down, now it's like, okay, euro dollar. Well, I got the 10 to 12s, the 11 to 1s. I got these 3 a.m.s, these 7 a.m.s, these 3 p.m.s, these 7 p.m.s, these 11 p.m.s. I mean, and every hour there's another one coming out, and it's overwhelming. So to make it really simple, you just hop in and use the scanner. And like I said, we're actually going to be launching this thing out, making the whole thing free. So you can access it right now, and it'll help you in starting to determine this. We have about 300 hours of free education on how to do the binaries and the spread, the straddles and the strangles. So let's see here. We got yeah, Nadex is not just trying, but they are actually putting deals together right now. They're already done in process. Those be future commission merchants, and they're testing all the software out right now. Once that is completely done, then they're doing all the beta tests and everything. Then they will be rolling out to the FCM. Should be able then to offer the ability, not simply a broker, but it's actually a future commission merchant. We'll actually be able to offer, which is it's a higher level. We'll be able to offer Nadex contracts directly. So that way you'll be able to get access to them. Okay. And you have to be a U.S. resident with a U.S. bank account, or you have to have a U.S. company with a U.S. bank account. So to be able to obtain an account, you can't just you can't have a residency outside the U.S. and have a U.S. bank account. So, but none of that should matter here in the next 60 days. Let's see. I want to read a question here. So going through step by step. Okay, so going in and looking at this, if we were to look at euro dollar and expecting a range bound strategy right now, Jim, okay? So let's say you're expecting the market just to go flat. We're going into the last half of the day, euro dollar, the European community is now closed. Nothing's really happening. So, what do I do? What are my next steps? I need to make a decision of whether I think the market is going to break out or stay flat, or if I just want to be directional. So you really have three choices, okay? It's going to go up, it's going to go down. I don't know where it's going to go, but it's going to go. Or I think it's just going to stay flat. You have to make that choice. And there are a lot of systems to do that. You're not going to get all of that in a 30-minute or 1 hour or 2 hour webinar. So fortunately for you, there are literally hundreds of hours of education that do go through all the steps in articulation, step by step, inside of our site for you. Okay, and you should not jump on something just because you hear 30 minutes of an explanation. You should definitely dive in and get the basics. We go in here and we teach you Nadex tutorials, getting started, platforms, ABCs of spreads, ABCs of binaries. And then we have all these bonus webinars where we go into step-by-step detailed layout of specific strategies. So all that's there and available for you. So we're here to expose you to the possibilities of what's there. And I'm not charging you for any of that, okay, at all. No catch, no nothing, it's just there, okay? So you go in here and, you're tempted, but you're like, this thing just looks like it's sort of done, it's cooked. And, you double check the news. I'll go over. There's a lot of websites, real popular one, Forex Factory. If you don't know this one, this is one you want to save, okay? So I'll go over here to Forex Factory and to see, is there anything I need to be aware of coming out this afternoon that could just knock the market off its rocker? Nothing really come out. All the news coming out today is done. Okay, so I want to do a range-bound strategy. And so I go down, and I want to just focus on euro dollar. And so I go, what's available for me on euro dollar? I'm now to 3 o'clock. Is there any, what's my best, what's the best trades I can find? And am I okay with the risk reward and the setup and everything else? And sometimes I'll take on more risk because my probability is much better. It's much higher. Sometimes I won't. I got to look at the different pieces that come together. So, well, the best one I can see, out of the gate is I got, this 1 o'clock right here. As far as just profitability, I can make 21.50 on this trade. I can make 27 on this trade. And but it would have to stay between 37.17 and 36.97 for the next basically 2 hours for that trade to. It may not have to stay within, but it's at least have to expire within. So if I go over here, let me throw on a little thing that lets me do measurements and draw tools. It makes it easy. Okay. So I'm going to go over here. Thought I added it on. One more time. Tool off. And apply. There we go. So it would have to stay between the strikes. 37.17. That's not too bad. Okay. That's right at a volume spike level. It's right near a deviation level. It's the high of the day. Okay, so that's not actually a bad strike to sell. And so right now, I mean, I would actually feel very comfortable selling that trade. So I'm going to at least do one side of this. We're going to go in here, and you pop it up, put the trade on, choose how many contracts you want to do. Oh, that's 37.27. I want 37.17. There we go. 37.27 is even better, yeah. And so I throw that trade on. Maybe I do a couple contracts. Whatever you're comfortable with, whatever. Okay. So throw that one on. Grab that. Okay. Now that trade is filled, I'm gonna set it aside for a second. We'll come back to it. Okay. Now we're gonna go. Okay. What about the bottom side of the butterfly? Well, let's look at that. I got a 136.97. So I like the top strike. Do I like the bottom strike? 136.97. Right there. Okay. I like this one up here. 136.97. How comfortable do you feel that that thing's not going to be hit for the next 2 hours? And this is where I want to, I think one of the things that he was, stressing on earlier was not just having the system, but actually looking at the market. Do you think it's a good idea to think that we can't hit this level in the next 2 hours? Not at all. Yeah. I mean, there is absolutely no good reason to think that that's a good idea. So you're just asking to get it handed to you, okay? So you have a couple choices on how you can handle this. One is you could just say, I'm just going to go directional, which is actually okay to just go directional. And now we're doing premium collection directional, which is nice because if the market, here's what's happening. By me selling the 37.17, okay, if the market stays flat, I will make, about $40 on that trade I just did, $20 times 2 of or whatever. If it goes down, I will make about $40 on the trade. If it goes up, but not up to my strike, I'll make $40 on the trade. Okay? Now, this is a scenario I don't suggest, but if it goes up past my strike and comes back in, I'll still make about $40 on the trade. All right? So I got a lot of probabilities in my favor. Now, the only way I'll lose, there's 2 ways I can lose. One, it goes up and expires above my strike, then I would take max loss. Not a good scenario, okay? So what might be an alternative scenario to taking max loss? This is something that's different about Nadex. I know y'all have talked about it already, but I mean, the big thing about Nadex is do you have to wait until expiration to close your trade? Yeah, Nadex fills are no problem at all. Even much larger contract sizes. Yeah, exactly. You don't have to wait. You shouldn't wait. Okay? So you don't have to wait. So let's say I'm going to bring in about $20 or so on a contract. Okay, let's say I sell it for $20 just to make it simple. Who can tell me? So pop quiz, I know I have a couple trades on here. Who can tell me what will a binary contract be worth? At least technically, what is a binary contract worth if the underlying market is trading at the strike price? So if the euro dollar did get up to 37.17, what would be that binary contract value? Ian, exactly, $50. So it'll be up there at $50. And the reason it's at 50 is because the binary's price is a somewhat of a reflection of probability of actually being in the money at expiration. Okay? So when you're at a price, there's a 50-50 chance you'll still be at that price at expiration. Therefore, I know that I could get out of the contract, okay, when it hits 37.17 at about 50 bucks. Now there's a reality of like bid-ask spread, you know, and everything else, all that involved. And so I could choose to exit the trade when it gets there. Now it's important to understand that these are limit orders, so you can't do stop orders on Nadex. We're actually making a plugin right now where you can here at Apex, but I'll show you that. But what we did is we added in this new step here where you can go to make it a virtual stop, and it actually says get me out of 10 ticks off what the market price is when the euro dollar indicative index here, if it hits 37.17, get me out. And so now that's a stop order. And I can even say, but, you know, if the market just flies and goes nuts, you know, I don't want you to get me out any higher than, you know, we could say 75 bucks. So that'd be the worst possible price at which you submit me out. Like, I mean, just say the market just flew in a heartbeat. Just, I mean, like, you know, ran right through. Don't submit this thing for like $95 because if I'm going to take, you know, basically a max loss, I'd rather just, you know, not get out. So if it does fly, but basically what will happen is the market will get up there. It'll be right around 50. It's going to submit a $60 order. If I submit a $60 order to buy and the market's at 50, I'm submitting a limit order on Nadex. A limit order means at this price or better. So if I submit a 60 and the market's at 50, am I going to get filled right away? So just to repeat that, if the market is at 60 bucks and I'm at 50 bucks, am I going to get filled right away out of the gate? If my limit, because remember, limit order means at this price or better. So somebody's like, was this a trick question? So yes, it'll be, you'll get filled right away. So if I submit an order right now to buy at 50, I'll get filled immediately because it's better to buy at 22 than it is at 50. So limit means at this price or better. So now what's cool about this is I'll hit activate the stop. And what this is doing is this order is now working. And the second that the market hits 37.17, you know, hopefully it doesn't, but if it does hit 37.17, then it'll submit my order for me immediately. So now that's a way to have stops on Nadex, so I don't have to have my finger on the button for the next, you know, hour and a half. So we're actually in final beta, and that we'll be releasing that here, you know, in the next week. But before you had to basically open up a ticket like this, and you had to sit here. You go, okay, well, let's put this thing in at, you know, say 60, and you had to just wait with your finger on the button, watching the chart every second. If it ever got up there, then you had to make sure you're there, ready, and disciplined enough to hit the button. So that's how you would do it without that virtual stop ticket. But as it is right now, we're doing fine on the trade. And there's another important aspect. Again, I don't have to hold till expiration, right? So what is not only do I need to get out if it moves up and hits my strike, you know, Jim, but what else should I probably do? If it's going in my favor, and if I am dependent upon it being below that strike at 37.17, which we're doing just fine, we got some volume spikes. We got some good stuff going in our favor. You know, it's moving down. We haven't made a butterfly yet. We can leg into it. That's okay. We'll come back. We'll check some stuff out. What might I want to do before expiration on this trade if I have captured most of the profit that can be made? Could I maybe take profit early? If I take profit early, what are the benefits? Trade can't turn into a loser, right? So my trade can't lose if I take profit early. And so if I go and I buy, like, say, at $4, here's where I got $4 from. I looked at the price ladder, and I sold like at $20 or whatever, right? So I go over here and go, well, what are the really cheap ones? Well, they're $4. So that's probably about as low. If I put an order to buy back at $1, do you think I'm going to get filled? And this is a mistake that a lot of Nadex traders will make. So I'm not going to get filled. So if I put an order to buy back $1, I'm not going to get filled. Unless somebody takes out the other 4, probably not going to get filled. Okay? So 4 is really the best I should hope to get filled for before expiration. Okay? Now that number may drop to 3 when we're like 30 minutes away. It may drop to 2. So it could get lower. But as of right now, the best I should really expect to happen is get out at $4. Now, the advantage is I get out of the trade. The trader can't lose. The trade can't lose because I'm out of the trade. The disadvantage, people would go, well, you just gave up $4 of profit. Well, I would say, well, maybe that isn't a disadvantage. And here's why I would say that, is because now my capital is free for another trade where I can go make another 20. Sometimes people hold on for that last $4 and they give up on $20. I would rather take my $4, eliminate my risk, and then go find another trade where I can make another 20. If I'm going to bring the risk back, I want to get more money for it. So take your profit, free up your capital, go put on another trade, and don't double up on your risk. Okay, so basically, I mean, in every way, it mathematically actually makes sense, even though you do give up some of your profit potential. So what I'll do on here is now either from the open positions, you can click this, and you can type in 4. Or if you're in the scanner, you can click on this little X right here. And then you can just, once it fills in, it'll fill in everything for you. So if you want to leave it up and working and all that stuff, you go, you know what, I want 2 of these and I want 4. Okay? To buy back at 4. Because remember I sold them. But sold them, I want to buy them back. And so I put that order in. And then what's happening now is it's working. I sold it at $18.50. Now it's going to be working to let me buy it back at $4. So if the market moves in my favor, then, that's going. And that's all I got to do. So now I have that order sitting there. Now, if my stop gets hit, I probably want to go back in and close this thing down. I mean, I'm only taking on $4 risk if I add it on, but probably do want to close down my stop order. If my take profit gets hit, I want to, so think of it like a sort of an OCO. We're working on an OCO ability. If you don't know what that is, it means one cancels the other. When one happens, it cancels the other out. But now I got my stop working for me. I got my take profit working for me. That side of the trade is done. And this takes you about 10 seconds once you just spend a little time learning how to do it, okay? I'm just trying to walk through some more detailed steps for you. Now, the next step is going in and going, okay, well, if I do want to butterfly this thing, if I do think we're really just going to oscillate, then I'm going to look for, a potential, zone where I think I might be able to find a good butterfly. And if there's not one there, and this is really important, like my goal to go in this trade was to do a range-bound trade. Usually the market's pretty much cooked. I mean, we're at, the day right here before Christmas Eve. You're not going to see a whole lot going on, okay? Did its run, got our volume spikes, and, if you want to see if it's done or not, one of the smart things to do is go over, analyze different markets, see what they're doing. Here, like inside of our trade room, we got the Russell, it's just, really oscillating. We got the Dow had a little bit of a pull down, but now it's not doing a whole lot. We're range bound over here on the ES. We do have some nice volatility on the NASDAQ. We're not trading that much right now. So you just sort of look across and see, globally what's happening on different markets. I can pull up, let's see, Brian's screen over here out of the trade room. You got gold trending a little bit. You got the FDAX just range bound. The indices aren't doing much right now at this moment. So, so I can of course pull up a dozen FX pairs and look at those as well. And let's see. All right, so Esteban here, he got 4 FX pairs up here. Sort of cutting off in a second. But obviously range bound on euro dollar. Not a whole lot happening here since 10 a.m. On the dollar yen, and you can just split or pull it more and more and more. He'll pull a whole slew of pairs. But anyway, so all that's happening right there. So I go, what? I really am comfortable with the idea of a range-bound trade, and honestly, I'd be more concerned about it dropping than I would about it going up. But I go down, I go, can I find anything? So right now I got this 36.97. Now down here I got a 37. 100. That really, that's actually worse. It's higher. right? So I'm getting more money. I'm making $33 instead of $24, but it's still, it's higher. And so I go, I don't know if I want to do that either. So looking at all that, you may go, there's just not a trade for me right now. Okay, or I could actually have to extend out further in time if I wanted to. And you go, well, if I'm going to find any kind of range bound, is there anything? Let's see, there's 37. Here we go down to 3680. But that's going all the way to like 7 a.m. in the morning. So I'm not going to manage that thing. I'm not going to be here for it. So I may go, I don't see one right now, and I'm just going to wait until the market drops further, and hop on it. Now the one exception is I may go in and go, you know what, the 3,700. This sounds funny, but you may go, I like that trade because I can make $30. The market does seem to be pulling up a little bit in that range, and if I got out at 50, I'd only lose $18 on the trade. So that's one way people look at it. Another way that I like to look at it is if I go, you know what, there's just no good range-bound trade. What am I going to do? Is I'll do the opposite. I'll do what I call a double binary, where I'll sell one because I'm making premium, right? So we're selling this up here to make some premium. And then I'll see if I can buy one below it. And that way, if the thing just really shoots down, okay, then I actually could, potentially turn a nice profit. So if the market does decide to flip around, and let's say go down below 36.87, so which would be a pretty big move. So I don't know if I would technologically really be looking for that kind of move. Then I could go in and add in, that variety of strategy. So part of what I'm trying to do right here is show you, you can do range bound, you can do breakout. Breakout would be the opposite. The other part is to go, there are a lot of choices, and it can feel really overwhelming. You may feel overwhelmed right now, but you don't have to. So what I would suggest is, so you don't, you're not alone in this. This is, this is new to you, and you're like, wow, this is cool, but man, this seems like so much, is hop over here to our site, and I want to say, we set up a link just so we can sort of know that you're coming, right? So investing.com/pub. You have the link on there, Morgan? So yeah. So apexinvesting.com/pub. All right. And I'll put that in there for you. There we go. So go there. It's free. It shows it's not available to me because I'm already signed in. But it's free. And then sign in right away. And I want you to check out a few things as your first steps to really getting going on this. One, let's just get your basic education down. Okay? So I want you to go to the Nadex tutorial videos of getting started, the platform, the spreads, the binaries. Okay? If you're ready or you want more advanced, then check over the webinar recordings, okay? Because we go into some really big details right here, like in bonus steps 1, 2, 3, okay? Bonus webinars. Another area, so you're going to have 3 areas that you really want to look at, okay? Area 1 is the education for Nadex with the bonus recorded webinars. Area 2 is the trading question forum. We get, hundreds of questions in here, and, people are always posted in, and we'll help you out. All right, in any area that you have questions about, NinjaTrader, butterflies, condors, on down the list. So you can already see there's been questions about that here just recently today. And then the third one that I want you to check out, so this is where you ask questions because you're going to have them. You can ask them for free, me and other traders that are trading Nadex, and I monitor every post in there. We'll be glad to help you out in any detailed questions that you have, okay? And then the third area is the scanners. So we got the spread or binary. By the way, my suggestion, pick one, get it down, then go to the other one. And if you go, which one? If you've been trading for a while, focus on the spreads. If you're new to trading, focus on the binaries. Because spreads are more like normal trading, but are a little harder to understand. But if you've been a trader for a while, they'll be easy for you to get. If you don't have a lot of trading experience at all, then you should focus on the binaries because they're really easy to get. A little harder to implement, but we teach you some really good ways to implement them. So pick one or the other, get that down, then add the other one into your arsenal. But watch the tutorials on how to use the scanners and do this simultaneously. So when you choose, like, I'm going to focus on binaries first, or I'm going to focus on spreads first. When you do that, go watch that and be ready for that, and do that while you're going through the basic education, because it makes a lot more sense. Okay, I mean, it literally, people think it's an advanced tool. It's a brand new trader tool. It's a, I've been trading it for 5 years trader tool. Okay, so it doesn't matter which one you are. That tool is going to help you out of the gate, and it's going to help you going forward. So the scanner and the education at the same time, but also the questions. Please use the forum. I want to help you out in any way I can, and we'll get you there. Okay, we'll get you there step by step. We're going to launch out a whole new series of trainings, sort of from an A to Z coming out, and we have a lot of that there already, but just new and fresh live webinar series, and I know we're going to be some of that with TradingPub, and hopefully I can help a lot of you out and help you get and master this. But it's, from my opinion as a trader, there's no better way to trade with defined risk, with higher probability setups, whether, like I said, it be range bound or whatever. I mean, that trade, I have a very low expectancy that trade that we put on there is going to lose. And I mean, it's right now we've got that spread that is down, so it's not even a big deal. And but it's a cool, and I get to be flat every day. I don't have positions I'm holding into Christmas that I'm worried about. If I'm flat, I'll cash out today, and I'll go out and I'll be with my family, and that's it. And I can pull that money out of the market. I don't have to wait a month or a week to open or close a trade. And what I used to be able to do in a month, I can do in literally a day now. So it's worth your time. I'm not going to tell you it's as easy as you want it to be, but I can also tell you it is not near as hard as you think it is. And I look forward to helping you out in any way I can. And I'll hand it on back over to Morgan.
All right, great. Thank you, Jim. Sorry, I was reading Jim's comment. Thank you, Darrell. And we appreciate you being here, guys. And yeah, Jim, I know it's a lot to take in. We did record it. We'll get a copy of the recording to you. And also, we have this available. I'll share this link, which has access to a lot of different videos that I think can help you along the way. And I'll put this link in here. But Darrell, thanks again for being here. And there's a lot of cool things to do. Like Darrell said, we'll do a step-by-step. And Darrell, I think probably next time we should do that. Maybe we'll do like a 2 or 3 part series. Or maybe we can do a video series that we can email to people where they could watch it on their own time. Might be good to have sort of intro and then have strategies after that. Yeah, like an ABCs. That'd be great. Yeah, we'll work on that. And Jim, great suggestion. So Darrell, let's work on that and put that together and email that out to everybody at the beginning of the new year. So, all right, everyone. Well, I hope that you guys have a great afternoon. We appreciate you being here for sure. Again, that was a fun webinar. It definitely went a little bit longer than we expected, but that's always good to have more education than we had planned. And just a quick reminder, for anybody that's around, I'll be taking part in a session this afternoon at 2 p.m. if you guys want to check it out as well. So thanks again to everyone for being here. Hope you guys have a very